As a financial advisor, the most common question I get is, should I pay down my mortgage or should I invest? It's a question that's relevant to anyone that has a mortgage, and whether you decide to take the passive approach of keep it in the offset account or just keep it against the mortgage, or actually invest in or debt recycling, it's one that's crucial to getting ahead. Unfortunately, in Australia, I've never seen a good historical analysis answering this question, so that's what I hope to do today. A common answer to this question is saying that, well, the long-term return of the share market is, let's say, 8%, and current interest rate is 6%, so it makes sense to take that risk and invest. Unfortunately, there's a couple of limitations of this approach. The first one is tax. So a common extension of this analysis is someone saying that, well, that 8%, that's made up of, say, 5% income and 3% growth, and they're taxed in different ways. So if we tax that at 39% and have the 50% capital gains tax discount on that 3% growth component, that gives us an after-tax return of 5.465%. They would then say that, well, that 5.465%, that's less than obviously the risk-free 6%, so it doesn't make sense. Whilst I would say that's a more accurate approach because at least you've considered the tax implications, I would say it's also very limited because it hasn't taken into account debt recycling, which is an option for Australians with a mortgage. And to learn more about debt recycling, have a look at this video here, but the crux of it is you're bringing in interest deductions into the mix, which improves this equation. The second and just as important issue is sequencing risk. So unfortunately, averages, be it the 6% interest rate or 8% market return, can be misleading, and markets unfortunately can jump around, or do jump around. That's one guarantee that we can have. So with my analysis, what I'm trying to do is overcome these two issues, being tax and sequencing risk, account for the income and the growth based on a historical approach and include franking credits, and also account for capital gains, because one of the advantages of capital gains is you don't actually pay that tax until you actually sell it. So that could be in 30, 40, 50 years. It will be at one point in the future, whether it's inherited or you actually make that decision in retirement. So here you can see the market data that I've used. Going back to 1990, you can see that returns jump all over the place. So here's the breakup that I've put in of obviously the portfolio growth and the portfolio yield. But just for comparisons, I'm just having a look at this column here. So here we can see the total return, just excluding franking credits for a moment. So when we actually look at these numbers in, say, 1990, and that's the first year of the analysis, we can see that was obviously a horrible share return year, whereas interest rates were very high. So you'll see in the analysis, obviously, what that does to that particular sequence in that year. So then what you can actually look from that is that, well, here's kind of a summary. So averages, and this comes back to that prior question that I had just a moment ago. You can see that the average here is 9.42% of the share market and 6.89% of obviously interest rates over that period of time. The median, which is obviously the middle number of all of these numbers, is 10.34%, so a little bit higher. And the interest rate is 6.66%, so a little bit lower. And then you can see the big variability in the minimum and the maximum. So obviously interest rates, like they're never negative, and that's one of the risk-free advantages of it. So you can see that there's no negative periods, whereas there were 9 years where they were actually negative. So we can see here, obviously 1990, 1994, 2002, etc. So looking at that, obviously they then give different outcomes. So the absolute highest interest rates, which you hear from different generations, is in 1990 it was 14.52%, and obviously coming down from there. And you can see different years, obviously it was particularly low during COVID, and then it's gone up again. And then you can see during the share market that the worst return was negative 30.52%. So that was during the calendar year of the global financial crisis. And then we've got a maximum of 36.69%. So it wasn't the quickest recovery, it was a few years thereafter, so in 2013. And these are calendar years, not financial years, because that was what the most reliable data was based on. And so this data I probably should have mentioned before, but it's based on a portfolio of 40% Australian shares and 60% international unhedged. So obviously portfolio allocations, like the desired allocations, can differ. But I would say that's a pretty common kind of split between Australian and international. There might be a little bit more kind of diversification. So people might bring in hedge into the mix, or emerging markets or small companies. But for the sake of this exercise, it wouldn't move the needle too much. And for these numbers, obviously, I've done the analysis on different kind of tax rates. But with the numbers today, I've based it on 135,000 income for a couple, and 39%, so that being their marginal tax rate. It's important to note as well that I've also accounted for capital gains. So what I've done with capital gains is I've only realized that capital gain at the end of each period. So if it was a 10-year analysis from, say, 2013 to 2023, in that year, in 2023, at the end of that analysis, that capital gains tax was realized. So the reason why I've done that and done it by that approach is because at one point in time, capital gains will become realized. There's an argument to that, which I can appreciate, that people will say, well, I'm never going to realize, and if I do realize it, I'll realize it in retirement. If that's the case, your income's likely going to be lower in retirement. But at that point in time, this portfolio is obviously going to be generating passive income, which hopefully doesn't make you a non-taxpayer. And what I've done as well is I've only taken that tax out at the end of the analysis of that particular period. So one of the beauties of capital gains tax is you don't actually pay it until it's due. So you effectively get compound returns on that tax liability. So this takes into account that advantage. So I mentioned a moment ago debt recycling. So when I ran these numbers, I effectively compared three scenarios. So paying down the mortgage, not debt recycling, but investing, and investing in debt recycling. So to make it a little bit simpler, we can actually cross out one of those being the non-debt recycling equation. So if we look over here, when we're comparing not debt recycling and debt recycling, we can see the different, like the summaries over these periods of time. So these numbers, you can probably just focus on the difference down here. And this is comparing debt recycling to not debt recycling. And you can see here that the average is always better than not debt recycling. So by doing that, we can see that under every single example, debt recycling, because you're just bringing the tax deductions into the equation, is going to be better. So over 10 years, you're 23% better off on average of debt recycling versus not debt recycling. And you can actually see here, if we look at like the number of negative periods, you actually reduce them over time. So you're actually reducing your risk and increasing your return, that's an unusual equation outside of debt recycling in finance. So with that, it makes it a little bit simpler in terms of now we can just consider investing via debt recycling to paying down your mortgage. And so here I've got a graph just hoping to outline the complexities of the analysis. So what we're looking here is each year, so 1990 to 2023 being the data years. And obviously, the earlier you invested, the longer that sequence has been able to play out. So 1990 to 2023, that was 34 years that's been able to play out. So you can see here, if we just look at 1990 in isolation, for instance, we can see here that if you remember back to those prior returns, obviously it was 14.52% interest rate, and it was a horrible investment year. So obviously when you compare that equation, in that year in 1990, you would have been better off, at least in the earlier stages, to have actually paid off your mortgage and kind of lock in that 14.52% risk-free return. And then with sequencing risk, the biggest risk with sequencing risk is a bad start initially early on in your investment journey. So you can see here when there's red early on, like in 1990 and the tech boom in the early 2000s and obviously the GFC as well, you can see when there's bad returns early on, that can lead to poor outcomes thereafter. So it can take a long time potentially to recover. Unfortunately, we can't really time this. So it's a mug's game to say that, well, I can predict in terms of whether this is a good year or next year. And it's a little bit of a luck in the draw. So if we look at 1990 being that's the longest journey period, being 34 years, you can see that it took a number of years, so 6 years, until you kind of broke even from that decision. And then we can roll the tape effectively. And then if we go along here, if we keep going, you can see that it actually goes negative again. So you can imagine that when the GFC hits, that you hadn't got enough returns versus paying down the mortgage yet. And when that GFC hit, and obviously it was negative on the portfolio, it actually goes negative again. And then when, say, if we look down here, when 2013 comes into the mix, it makes a recovery again. So over 34 years, you were actually better off eventually, but until 24 years, when you've got these good returns of, say, 2013 into the mix, that was what, I guess, pushed the needle over to actually become positive. So 23 years, that's obviously a long time. So I would say we're all long-term investors, and that's probably one of the most important things with investing. That was obviously an unlucky year. So then if we go down to 1991, over that period of time, at the end of the analysis, you're 82% better off as opposed to 46% better off. And then so as we go down the years, you can see that it's very variable. So in 2002, obviously it was negative again. But if you started in 1995, that there's a positive outcome. So the one trend that we can see is there's blue all the way out here. So you can see here, the longer the analysis, that it does go blue eventually. In 23 years, that's obviously the longest time to actually break even and stay broken even. So here, 1990 is the longest time frame that we have. But what we can see is 1990, that was the worst outcome over that period of time in terms of the length of time it took to actually break even. That's a bit of an isolated year. So when we actually look at a summary, because I think a lot of people might be interested in kind of thinking for themselves in terms of what did 1991 look like, or what did 2000 if I was unlucky enough to start investing just when the tech rout happened and so forth. So you can see here during the GFC, which that's one that might be a little bit more top of mind for people, is so if you started investing in 2008, so if you had the decision at that point in time to say that I've got $100,000 or $50,000 in the offset account, should I debt recycle that or should I just pay down the mortgage? In that instance, it would have taken 9 years until that decision actually made it worthwhile. What this analysis does is it compares like actually paying down the mortgage. So there's a effective return of that being the interest rate. So it's always chasing whatever that interest rate is, and the interest on a mortgage, so that it compounds as well, because if you save interest by being in the offset account or just paying down the mortgage and creating redraw, that you then save interest on that amount of principal that you've actually paid down. So it compounds the same way as investment returns do. It's just saving interest as opposed to earning investment returns. So we can see here that after 2008, in 2008, it took 9 years for it to recover. Whereas if you just ignored the mortgage component and just did an investment analysis, I think it was about 5 or 6 years. So if you invested $100,000, that obviously went down. You include dividends in that, and then it eventually recovered after 5 or 6 years. So we've obviously paid down the mortgage. You've got the moving goalposts of the interest saving, always pushing it ahead. That's the beauty of it. So it just takes a little bit longer, so that you can see that then it eventually tipped positive after 9 years. And then all the way till 2023, you're eventually better off by 43% by making that decision. But it was obviously a rocky road. So then if we then compare, but jump back to that other spreadsheet and just have a look at kind of the periods, and I'll just hide this so we can just focus on the time periods here. So if we look here, obviously 1 year periods, that's a very short period. We've got 34 of them, that's a 34-year analysis. And the worst result would have been, it would have been 33% worse off by investing as opposed to debt recycling. So the worst result over 1 year would have been negative 33%. So that was actually the GFC, when you would have been better off just paying down the mortgage in that year. So 1 year is probably too short of a time frame. But so if we look at over, I guess, a reasonable point in time, so if we say 15-year investment, we've got 20 of those periods over this analysis. And you can see here that the worst outcome would have been, you would have been 24% worse off investing as opposed to paying down the mortgage. The best would have been 93%. So looking at the other data, 93% better off, that would have been 2010 in that instance. And the average would have been 23% better off. So if we look over 15 years, we've got 20 of those periods, and we can see here that the average of those periods where you were 23% better off over that period of time. There were actually 17 negative 15-year periods, so that's 35%. So the longer the analysis goes, the less of them they are. So jumping back to this data, what we can see is obviously returns are very variable, and that's obviously what's moving the needle most. So if you were to invest in a period of time when returns were obviously low or very negative and interest rates were particularly high or even just average, obviously that tilted in favor over that period thereafter of obviously paying down the mortgage. Whereas obviously vice versa to that, if you got a year where you're lucky enough, like 2013, where returns were good early on, that obviously that plays out to the scenario. Then I guess another kind of summary that we can make from this is that it's the age-old adage of investing is time in the market, not time in the market. So with that, the longer the period of time, the less likely you are to be able to actually see these red periods. So if we look here that over obviously 24 years, that's the longest amount of time. Up to 23 years, you would have been better off. But they're more and more rare, obviously, the longer the investment horizon goes. So here, there were obviously the early years of the early 2000s, and they were negative, but it becomes more and more rare. So obviously time in the market, that's one thing that's obviously crucial to any investing strategy. So, whilst there are situations that we need to consider where there are periods where you would actually be better off by paying down the mortgage as opposed to investing over an extended period of time, so up to say 24 years, I'd be interested to know, is that surprising to you in terms of that it took so long to actually break even from that decision? But the other consideration is say that on average, you are going to be better off over that period of time. So if we jump back to those other numbers, on average over these periods of time, that you are going to be better off over time. So 8% of the time over 23 years, you would have been worse off. Whereas from 24 years to 34 years, you would have been better off. There were no negative periods, so you're always better off investing over that period of time. So a general trend that we can see here is that obviously 1 year returns can be particularly volatile. So the number of 34-year periods, so there's 12 negative periods of that period. So we can look at 1990 to 2000, 2002, GFC in 2008, and so forth. One summary we can make from that is over time, it does reduce itself. So after it's 35% after 1 year, and then say after 10 years, it's down to 20%. After 24 years, you're always better off debt recycling as opposed to paying down the mortgage. So, what moves the needle? Obviously, as we just saw, is the returns in terms of the luck of the draw when you actually decided to make the decision. That can hugely impact the decision, not just in obviously over the short period of time thereafter, but also your luck over the draw in terms of the amount of success of that strategy over time. So the next one is time periods. So obviously, like any kind of investment journey, is you want to be in it for the long term. So you can see the chance of success increases the longer you actually stay the course of that. And just one note on that is it's crucial that you actually stay the course on any given decision. So if you decided to invest as opposed to pay down the mortgage, you wouldn't want to experience a negative return early on, so a GFC type event, and then change course on that, because then you've locked in those losses at that point in time, and the return of the interest over that period of time, because then that's effectively the return. That's the strategy that you've gone to. That if it was a horrible year, that's going to take years and years to actually even break even from that situation. So with time periods, that's one thing that obviously moves the needle. So you just want to make sure that you're a long-term investor. So the next one is income. So I've obviously based this on a couple earn 135,000 just to keep it simple for this analysis in terms of constant. So another consideration for people could be superannuation. And I won't go too in depth with this because I haven't added this to this analysis in this instance, but I will in the future. So with superannuation, you obviously lose access to that until 60 or when you retire thereafter, but there can obviously be huge tax advantages on offer. So if you're making concessional tax deductible contributions, and that's $30,000 each year, that's always going to be superior because you effectively get the boost from day one, even if the returns are negative, of the tax saving in that instance. So that's just going to hugely improve the numbers. So it would tilt it more in favor of investing via superannuation as opposed to debt recycling versus paying down the mortgage. Even though you can't actually debt recycle into superannuation because you don't get the tax deductions on the interest from those borrowed funds, if that makes sense. On non-concessional, it would be a little bit more variable, and I'll put out a video on that in the future. Another consideration for Australians is investment property. So you can actually debt recycle into an investment property. So it's the same concept of just structuring your debt right by borrowing for the deposit, or a lot of people might actually then borrow more to invest into that investment property. So debt recycling, it still works, but this analysis doesn't consider that. It's always one that I'm thinking about doing, but it's a different kind of equation because often you're taking on more risk. So obviously you're bringing about more leverage, and investment returns on property, it's not as consistent in terms of any property can give hugely different results. So obviously with market data, they're variable by year, but you can look at a 40-60 portfolio, for instance, and see a historical track record of that. Whereas with property, if someone invested in Sydney or Melbourne or Queensland or wherever it might be, obviously they can provide very different outcomes, not even considering the type of property, etc. So with that, you can debt recycle into an investment property, but the analysis would be harder. And I'm not even sure how valuable it would be because the returns can be so variable and it's hard to actually get good historical data on that. So what's best for you? So I think it comes back to your capacity. So how much do you actually have available? So obviously, you need to consider to make sure that you have an emergency fund that makes you and your family comfortable. And then from that, you can actually say that we've got this amount to invest. So let's call it $100,000. And so that's your capacity to be able to actually invest. And then obviously your risk appetite. So some people might look at these numbers and say that, well, it's obviously unlikely and I'm a long-term investor and I've got other buffers like the emergency fund and a strong stable income. So people might have a high risk appetite and put all of that $100,000 into the equation. Some people might be more risk adverse and do none. So I think the important thing is that both can be a good decision, but I think it's always good to actually understand your decisions and make a decision, because paying down the mortgage can be a bit more of a passive decision because you don't actually have to do anything. You can kind of just leave it in the offset account. Whereas obviously debt recycling, there's a few steps to it, and it's a decision where you have to obviously structure it correctly, and you have to open up a brokerage account and purchase your portfolio or ETFs or whatever it might be. So it's a decision either way. So it's just important to be conscious of, I guess, what road you're taking. So with personal finance, we all like correct answers. So definitive answers: should I invest or should I pay down the mortgage? And unfortunately, with finance, there's almost never a 100% right answer to these questions. Rather, it's a case of what's right for you and just being aware of what's moving the needle. So I find a lot online, people will say that I have $100,000, for instance. Should I do it this? It's either $100,000 investing or debt recycling, or 100,000 just leave it in the offset account. Whereas you can take a balanced approach. So you could say that I'm going to debt recycle $50,000 and I'm going to keep 50,000 in the offset, or pay down the mortgage. So that there's no right answer. And often when I'm working with customers, it's somewhere in between, just seeing what's going to be right for them and is that going to help them achieve their goals. And an extension of that is as well, you don't have to invest it all in any given year. So we wind back the clock and pretend that we're in 1990 and you have $100,000 to debt recycle. You could make the decision to drip feed, or sometimes referred to as dollar cost average, that into the market. So you could say, of that $100,000, I'm not going to put it all into the market on 1 January 1990. Rather, you could decide to say that I'm going to put in $10,000 per month over 10 months. And then what you're doing with dollar cost averaging is you're just kind of narrowing the range of potential outcomes. So you're not going to get that absolute best outcome from the analysis. And similarly, you're not going to get that absolute worst outcome. Rather, you're going to get somewhere in between. So I think sometimes online I can find that dollar cost averaging or drip feeding into the market can get a bad rap, and people probably don't consider it as much as I think that they should. And this usually comes back to people saying that, well, there's studies out there because the market generally trends up, as we saw, that obviously based on that, on average, you're better off, I think it's around 60 to 70% to get into the market sooner rather than later. But I think with these decisions, if it helps you actually be more confident making a decision to say that I'm really scared to be in that 1990 scenario. So if it allows me to actually make a decision, invest, and knowing that I'm not going to get that absolute worst outcome, I think that drip feeding into the market can actually be valuable from that. And just reiterating again, whether it's the drip feed into the market strategy, or just obviously more generally with the decision to debt recycle or invest or pay down the mortgage, it's just crucial that you obviously stay the course. If you want more information, you can go to edvest.com.au and you can download the white paper where I've put together these numbers, this analysis with a few more graphs and just a little bit more information. And I'll put out more videos on it in the future. So if you have any questions, feel free to reach out. Otherwise, thanks so much for watching, and I'll see you next time.